Question number 4 of SBR September-December 2020 paper. This is the last question and then we are over with September-December 2020 paper. By the way, if you haven't seen my first three videos on first three questions, please do check them out. Right? You can click on that I button on your right side above and get to the playlist and get all the videos of SBR. So coming to question number 4, as you can see on the subheading, employee benefit, definitely we know it is IS 19 they are talking about. Next, so this is a short case study. Quickly we can go read the requirements. Discuss the nature of IFRS for SMEs. This is not a very frequently, but you have to know IFRS for SMEs and the principal differences between IFRS for SMEs and full IFRS standards. Difference between full IFRS and IFRS for SMEs, 4 marks. So 2 differences will be enough for you to get the 4 marks. Next, discuss the effect that information asymmetry can have on the decision to invest in SMEs. Information asymmetry. What is information asymmetry? One part is having more information than the other. It's not symmetrical, right? Third, discuss how integrated reporting can help SMEs better understand and better communicate how they create value for investors. Integrated reporting for SMEs, okay, not for anything else, but for SMEs, how they can help. Now, whenever some note is there, please read the notes carefully. As I've told you, the other professional 2 marks comes in your question 4, which is here, and the other is in your question 2. Note, you do not need to refer to any information relating to hand food company in your answer to part A. So clearly they have told hand food company's information you don't need it for part A, only for part B. But still, so we'll leave part B, we'll just answer part A. This also you can do, or you can read the whole requirements and all the whole case study and then answer, which I don't usually practice. So, right? So it can be argued that SMEs face financing difficulties because there is serious information asymmetry between SME and investors. Information asymmetry in the context of SME means that the SME has access to relevant information while the investor suffers from a lack of relevant information. It can be argued that IFRS for SMEs decrease information asymmetry between the entity and the investor. Where SMEs leads in product and service innovation, they can also lead in innovation for integrated reporting. There is a clear, concise, and persuasive case for why SMEs and their stakeholders stand to benefit greatly by using integrated reporting. So that's it. Much information is not required here. This you can even give from your knowledge. This is a knowledge-based question. Not much relating to case study. For part A only. Right? So now let us go to the answer and see part A, which is very easy. You should be getting the most of your marks in part A, if not in part B at least, from your knowledge. So now the principal aim when developing IFRS for SMEs was to provide a framework that generates relevant, reliable and useful information and the provision of a high quality and understandable accounting standard suitable for SMEs. So the standard itself is self-contained and incorporates accounting principles based on full IFRS standards. It compromises a single standard divided into a simplified sections for each relevant IFRS standard, but which I have also omitted certain. It has omitted, by the way, certain IFRS standards which such as, what are those? You can even give examples like EPS and segmental reporting, because usually small business will not have so much of segments, and also EPS is a market information. You will not have such a big market to get EPS. In addition, there are certain accounting treatments that are not allowed under IFRS standard. For example, you can even give examples. The more examples you give, the better it is for you to get more marks. There is no separate guidance for non-current assets held for sell. For what? IFRS for SMEs. To this end, IFRS standards make numerous simplifications. It makes numerous simplifications. That's what SME standards does. It simplifies the full IFRS standard to the recognition, measurement, and disclosure requirement in the full IFRS standards. Examples of the simplifications. Give examples. Wherever you find you can give examples, please give examples. It is recommended. Based on the marks, of course. It is for, wait, let me see how many marks. I forgot it is for 4 marks. So intangible assets must be amortized over the useful life. It is, if the useful life is not determinable, then it is presumed to be 10 years. This is not in your full IFRS standards, right? The cost model investment is measured at cost less any accumulated impairment. May be used for investment in associate. This model may not be used for investment for which there is a published price quotation, in which case fair value model must be applied. Now the disclosure requirement. So this is all your recognition and measurement. Now comes your disclosure. Disclosure requirement in SME standards are also substantially reduced, because you have to talk about the differences, right? So substantially reduced when compared with those in full IFRS standards, in part because they are not considered appropriate for users' needs and for cost-benefit considerations. Many disclosures in the full IFRS standards are more relevant to investment decisions in capital markets than to the transaction undertaken by SMEs. The SME standard is naturally a modified version of full IFRS standards and not an independently developed standard. They are based on SME standard is not something a new standard or a developed standard. It is not independently developed. It is all the rules in SME standards. Principles are taken from the full IFRS standards only, but some it is omitted in some area, some it is more simplified, right? And some the extent like disclosure is reduced. They are based on recognized concepts and pervasive principles, and they will allow easier transition to full IFRS standards if the SME decides to become a publicly listed entity. Yes, sometimes when SME becomes a bigger company, publicly listed entity, then it has to change from SME standard to full IFRS standard. That time it will be easier for them, right? Coming to the next, information asymmetry. If you have forgotten what the requirement asks, please read. How the information asymmetry can have the effect it will have on the decision to invest in SME. Again 4 marks. So I suggest 4 points. Information for SME decreases IFRS for SME decreases information asymmetry between firm and user, right? That means, what does this line means? Please understand line by line. Decrease information asymmetry means both the parties, the firm and the user, will be having more or less the equal or similar information. So that information asymmetry is reduced in SME, not in full IFRS. So because of its recognition, measurement and disclosure requirements, because it is simplified, therefore much is not hidden. Both the parties more or less know this, have access to same type of information. So therefore that information asymmetry is not much in IFRS for SME. However, there are certain facts and information in companies which is not disclosed by them to investors under any accounting standards. SME have access to all relevant information while investors lack much of the relevant information. Unfortunately, lack of relevant information will have an adverse effect on the decision making of the investor. We know when there's not relevant information, even investor cannot make good decision. So information related to SME's credit, project risk, benefits are known more by the SME than by the investor giving the SME information asymmetry exactly. What is their credit? What is their project risk? What are the benefits? Who knows this? SME will know this more than the investor. Therefore, investors are in a relatively disadvantaged position. And if they, for example, are financial institutions, let's say bank or insurance company or pension, they will raise lending rates to reduce potential risk of credit. Exactly, they will increase their risk. They might increase their borrowing rate or lending rate or whatever it is, because they want to protect themselves from the risk of credit losses or may not invest at all. The more incomplete and the less transparent the information from the SME, the higher will be the risk related to investment. See, the less transparent, that means not transparent, not complete, there's a higher the risk, right, related to the investment, and higher will be the return that the investor requires. The access to investment by SME could be determined by the quality of financial statements. Information asymmetry and perceived risk. Quality financial statements reduce the level of information asymmetry, which reduces perceived risk. Yes, if your financial statements are of quality, again it's a sign, it's a good sign. That means your information asymmetry is less. Therefore, risk is also less. Next is integrated reporting. Third, how it can help better understand and communicate to the investor, value to investors for SMEs. So here also quickly I can go. These are all general knowledge and easy to answer, not much difficult also. Integrated reporting could help SMEs better understand and better communicate how they create value. It can provide a roadmap for SME to consider multiple capitals that make up its value creation. We know the 6 types of capital that makes up the value. An integrated reporting presents a more complete corporate report which will help SME understand their business so they can implement a business model that will help them grow. SME uses a range of resources and relationships to create value. An integrated reporting approach helps SMEs to build a better understanding of the factors that determine its ability to create value over time. Integrated reporting helps SME gain a deeper understanding of the mechanics of their business. This will help them access the strength of their business model and spot any deficiencies. This will create a forward-looking approach and sound strategic decision making. Some SMEs have a few tangible assets and operate in a visual world. As such, conventional accounting will fail to provide a complete picture as to its ability to create value. Capital such as employee expertise. Okay, they are giving examples of capital, employee expertise, customer loyalty, intellectual capital property, which will not be accounted from the financial statements, which are only one aspect of SME's value creation. Sometimes what happens is your company, the value which they get is not only through finance, not only through money. It could be maybe your customer is loyal, maybe you have great employees who are very good in the expertise. So all these are not captured in what annual financial statements, right? But they can be captured in where? In integrated reporting, which are only one aspect, only one aspect of an SME's value creation. Maybe your value is already created through this one aspect, right? So as a result, SME stakeholders can be left with insufficient information to make an informed decision. Exactly. So integrated reporting will include key financial information, but that information is alongside significant non-financial. Also, integrated reporting have non-financial information and narrative information. So integrated reporting can help fulfill the communication needs of financial capital and other stakeholders and can optimize reporting. Now coming to part B. Part B, we have to use a case study. So part A for 6 marks, discuss with suitable calculations the principles of how Handfoot should account for the current service cost. Suitable calculation means you have to do some calculations, by the way. How current service cost can be accounted of as additional employee benefit on this date. Next, discuss the impact of the additional employee benefit for the year ended this. Now it's 1 year. If Handed were to take into account the following changes in assumption. What are those following changes? An increase in employee salary above 3% per annum, a decrease in the probability of employees leaving the company. Under both this, there is no need to provide any calculations in your answer to second part B. No calculation is needed, by the way. Right? For the second part of B, which is for 4 marks. But before this, we have to read the case study. Handfoot is a small medium-sized enterprise which has introduced a benefit to encourage employees to remain with the entity. The company's financial year is 31st December and it prepares its financial statements using IFRS standards, but it is interested in the differences with IFRS for SMEs. Employee benefit. 1st of January 2002, Handfoot introduced an additional benefit to employee and encourage employees to remain in employment for at least 5 years. Handfoot has promised its employees how many years? 5 years. Has promised its employees a lump sum benefit payable on 1st of January 2007 with an equal of 1% of their salary on 31st December 2006, provided they remain employed until that date. The current salary of employees on 1st of January is this. So the current salary on this is this much. 1.1 per year. The debtors of Handfoot have used the following assumptions. Salaries for the year ended will remain at this one. Okay. That means, yeah, after 1 year. Or salaries will increase by 3% from 1st of January 2003, or there's a 75% probability that all employees will still be employed by Handfoot on 31st December 2006. The discount rate is 5% per year. Now, Handfoot recognizes actual gains and losses in other comprehensive income. Interest is recognized by Handfoot on an annual basis. Handfoot uses projected unit credit method to measure defined. We know that in IAS 19 it says that you have to use projected unit credit method to measure defined benefit obligation, which means that the current service cost is the increase in the present value of the future defined benefit liabilities. The benefit will be payable from the balance on the Handfoot's business bank account. Right? 5%, 4 years and 5 years. So now let us do the calculation and find how current service cost will be accounted for 31st December 2002. Before that, let us read this paragraph. Handful should recognize a liability for the obligation as a result of the additional employee benefit. Yes. Because you are giving additional employee benefit, you have to recognize what the company have to recognize a liability for its obligation. It's an obligation, it's a liability. You are giving additional employee benefit net of plan assets. So the treatment of this payment is similar to the defined benefit pension scheme, but the difference is, what is it? Defined benefit pension scheme. The payment is similar to that, but the difference is that any actual gain or losses are recognized immediately and not in other comprehensive income. They are recognized immediately. Actual gain or losses recognized immediately and not in other comprehensive income as handful does at present. Where does handful record it at present? Other comprehensive income, but no. Any service cost, net interest and remeasurement should all be recognized in where? This you have to write. Before you do calculation, you have to write where each will be recognized. Service cost, net interest, remeasurements, recognized in P&L. In this case, Hanford is going to pay the benefit out of the cash, and therefore there will be no plan assets. Okay, he's going to pay the benefit out of cash, and therefore there will be no plan assets. Hanford will recognize the net actual change in the liability during the 5-year period as a service cost. So the company will measure the benefit liability at the present value of its obligation at the reporting date. This amount is the estimated amount of benefit that employee have earned in return for their service in the current and the prior periods, including benefits that are not yet vested. The benefit is based on future salaries, and therefore the projected unit credit method requires an entity to measure its defined benefit obligation on the basis that reflects the estimated future salary increases. The component of the cost of the additional benefit will be recognized in P&L, which will include the current service cost. In the P&L, even the current service cost will go. This you have to calculate. So for the year ended, see how they have written nicely. You have to write the date. Date is very important. 31st December 2002. So Hanford recognizes a current service cost expense of this one, 7.7. How they have got? Working is here. They have got a cost expense. Dropping down the 3 zeros. Okay, so the expected final salary will be how much? 1.1 was the million, right? This is, it's not down. This 4 will be here up. Let me write with the red pen. This 4 will be up here, not down. Three to the power 4, 3% to the power 4. We'll see again. Because here they told salaries will remain at 1.1%. There you don't have to do any changes. Salary should increase by 3% each year from 1st of Jan 2003. Right? So from 1st of Jan 2003, and the current salary is when? 1st of Jan 2002. That means from 1st of Jan 2002 to 31st December 2002, it will be 1.1. So that 1 year we are not taking. They have to remain in the company for 5 years. So we are taking this 4 years from 1st of Jan 2003. That's why it is 3% to the power 4, not 5. Because that 2002 will not be taken. Because it will increase from 2003 onwards, not 2002. That's why to the power 4. Next. Base is benefit for the current year. So once you get the expected final salary, what happens? Benefit for the current year, how much? Based on this final salary, you will get a benefit of 1%, which is 12.4. Right? We'll see. They have told that which is equal to 1% of their salary at 31st December 2006. The benefit will be the lump sum benefit payable on 1st of January 2007, which is equal to 1%. So 2003, 2004, 2005, 2004, 5, 6, 7. Right? 4. Next. Adjust the benefit for the current year. Adjusted benefit for the current year. So this 12.5 you have to take 75%, which is 9.3. We'll see how 75%. because there's a 75% probability that all employees will still be employed. 75% probability, that's why we have to adjust it, the benefit. And then once you get 9.3, what do you have to do? Current service cost, you have to discount at 5% over 4 years. So discount rate they have given you from 9,300, 0.823. This one we have to use. Which is 7.7. So this is the current service cost. This figure will be unwound each year. And the moment recorded as the current service cost insofar as no other changes to the assumptions. If there's no other changes, the moment recorded in the current service cost, that's it. Next, you don't need to do any calculation, so we just have to write it. What is it that we have to write it? For second part of B, impact on the additional benefit. If they make the following changes in the assumption, what are those changes? Increase in employee salaries above 3% per annum and decrease in probability of employees leaving the company. Because currently the probability is what? 75% will stay in the company. That means 25% will leave and salary will increase 3% per year. So an increase in employee salaries above 3% and a decrease in the probability of employees leaving the company would have the same effect on the additional benefit liability. The changes in the assumptions would both increase the benefit liability discounted at 31st December 2003. This would in turn increase the current service cost. So even the current service cost will increase because of that. So think. Don't just memorize that this will increase, this will increase. You will not understand how they are told benefit will increase, liability. Why? See, salaries are increasing by 3% per year, right? So that is one increase. Benefit liability also will increase. That means you have to give more benefit because increase in salary. 1% on the salary, right? So salary will increase 3% every year means benefit also will increase on that increased salary. Next, decrease in the probability of employees leaving. That means more employees are staying. That means 75% are currently staying. So if the 75% is increased to 90%, that means more employees will get the benefit. So that's why that benefit liability will increase. Because that benefit liability will increase, what happens? Current service cost also will increase. For the year in P&L, as a benefit payable on 1st of January will have increased as well the number of the employees to whom benefit will be payable. Just now what I told. So interest which is calculated on the opening balance of the benefit obligation will not be affected by the change in assumptions. Interest will not be affected by the changes in assumptions because interest will be on the opening balance only of the benefit obligation. So it will be charged to P&L at what? 5% of 7.7. Actual gain or losses arise when the assumption changes. Yes. So when assumption changes, actual gain or losses will arise. In this case, because of the changes in assumption, any actual loss will arise because of the increase in actual loss. It's a loss, right? If more of the benefit you have to give to the employee, it's a loss only. Will arise because of the increase in benefits payable and an obligation, and this will be charged to P&L. Right? So interest was 5% on 7.7. Current service cost is 7.7. So 5% on that is 385. That will be charged to P&L. So that's it for question 4. And please go and check the marking scheme. And with this, I completed all the 4 questions of September-December 2020 SBR paper. You can check my other papers also. 2019 September-December I've completed. And if you want me to complete any other paper for SBR or AFM, let me know in the comment section below. And don't forget to subscribe to my channel and do take care.